Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for. And what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners. Thank you for joining us this weekend. Hopefully everybody's having a great week. Wow, risk does happen fast, doesn't it? It's crazy in this market, and we often talk about just how fast risk happens and risk comes on, and then individuals start to think about down markets, they start to think about the what ifs, they start to think about the contingency planning, and that's unfortunately not the time to start thinking about it. The time to start thinking about it is during the reviews that you have either mentally or with your portfolio advisor, or if you're managing the money on your own. I think the question is to always ask, what if? And that's something we're going to talk a lot about today. So Kuhn Capital Partners, as you know, we're a registered SEC investment advisor. We're a fiduciary. We're headquartered in the Chicagoland area, just outside of Chicago, actually, in Oak Brook. We do have more of a national client base, obviously significant amount of investors here in the Chicago area, so that's fantastic. I love the fact that people just stop into the office, and that is something that I've been talking a lot about on the radio. We love to talk investments, and if we can help you and you don't have an appointment, or if you feel that you just like to chat about investments and you're in the area, stop in. We are 1415 West 22nd Street, Suite 530, so right across from the mall, Kuhn Capital Partners. Website, again, I think I've been saying this for 3 years. Website redesign is about to take place. Given the strategies that we talk a lot about on the radio, we are really trying to make our site an educational site, a site that you can do your own due diligence, that you can do some work on your own, and then determine if you want to meet us. So we're actually very, very excited about that. Website's KUHNCP.com. So more to come on that. But if you'd like to get in touch with us, if you'd like to schedule a call, go over or create or stress test your financial plan, give us a call, 630-492-1912, 630-492-1912. Set some time up with Brian, myself, and our team, and we'll certainly be there to address any questions that you have. So obviously the markets are volatile. Risk does happen incredibly fast. I think when you look at the role of an advisor, it's to still make sure that you have strategies that can protect and strategies that can still deliver positive returns even in negative markets. And I say positive returns, cash flow. And as you know, the banknotes are something that we spend a lot of time talking about on the radio. If that's your first time listening, the banknote is offered by a major bank. JP Morgan, Citi, Bank of America, Morgan Stanley, UBS, BMO, BNP, Bank of Canada. There's just so many banks, but they're all tier one banks that are the largest, what we believe to be the largest financial institutions in the world. And they are called banknotes, structured notes, enhanced income yield notes. Every bank calls it something different. But at the end of the day, what the banknotes do is they pay distributions, coupons, interests, call it what you want, but they are pricing, again, with the volatility very significantly. This week we did a 14.25. I can't remember the bank that we did. You can just call in 630-492-1912 and figure that out. We can send you the prospectus of the bank note that we just did. I think that's always a good way to before you do it, I think it's a good way to, to make sure that it's something that you want. So, and again, anytime we talk about strategies on the radio, it's so important to know that it's for informational purposes only. I have no idea without talking to you, without addressing your current situation, if it makes sense for you or if it doesn't make sense for you. But they are pricing strong. So this actually, the last one that we did was 14.2, I think 14.25. And you get that as long as the indexes, the notes track each month. And again, it's from issue. So the day you issue, they lock in the price of those closing indexes. And then each month, they simply look at those indexes. And as long as none of them are down more than 30%, you get your monthly coupon. And this one was 14.2 something, 14.25, I believe. And so you can see that even in these scenarios that we can still cash flow at a positive rate. I mean, 14.25 with 30% downside protection is really, really strong. And the notes are pricing again with volatility. Great. And that's just the job of an advisor, right? I mean, the job of an advisor, in my opinion, is to make sure that you just have something in your portfolio that can deliver even if the markets aren't. And the markets, the volatility, I don't even think the real volatility has started yet. I think the market, with all of the option pricing, I think the market is I think it's artificially kind of staying at these levels. So I think the volatility could really start to kick in mid-month, and we want to make sure that you're protected. And you know that we do a lot of the bank notes. And again, those are pricing very strong. But another strategy we often talk about on the radio, which is our strategy, so it's Bison 2. It is a energy investment. And you know what has happened to the price of energy and the price of oil. And we stress test and we run all of our economics really in the $60 a barrel range. I mean, we stress test into the 50s, into the 40s, but we really try to run all of our economics at $60. And everybody reaches out to us, at least is my belief, when it comes to the energy strategy. Again, when you invest, before I go there, but when you invest, right, you don't just want in my opinion, a buy and hold strategy. And that is what the bulk of advisors are doing, dressed up as something so unique, dressed up as something so proprietary, dressed up as something that only they have. But the strategy just simply has two asset classes generally. It has equities and it has fixed income. And then you're going to track the market up and you're going to track the market down. And in 2026, when you look at the studies that higher net worth investors, the ultra high net worth investors, and how they invest, it is dramatically different than the $1 to $15 million investor. And I think that's just because of the advice of the advisor. There's, the $1 to $15 million investor kind of is in no man's land. And, advisors are really using the same strategies for their, $3 to $15 million investor that they're using for their $500 million investor. And again, we work with everybody. So, we love to educate, and that's our job. That's our goal. That will never change. But it is definitely different. You have access to different strategies, the more assets that you have. And so we've always believed that the $3 to $15 million investor is kind of in no man's land, still utilizing kind of retail type strategies. And that's just not good enough. So 630-492-1912. But anyways, the energy strategy. So the tax benefits are significant. We're coming up upon tax time. We're not tax advisors. We're not providing tax advice. It's for informational purposes only, of course. Best practice, always reach out to your tax professional. That's just kind of everything that we do. Anytime we talk about performance, it's always not back tested, but it's always historical. Historical performance is not a good indicator in most situations of future performance. And then when it comes to taxes, it's for informational purposes only. The energy strategy is significant. I can't tell you the amount of clients that we've talked about that especially in the kind of the $3 to $15 million range that are using, I don't want to name the names, but there are several big firms that are using leverage that are going long, going short, and then claiming that they're able to reduce taxes. Well, in my opinion, it's more of a deferral it is more of a deferral than a reduction. And so if you're looking for true strategies that can reduce active, passive, 1099 W-2 taxable income, and the energy space, whether it's our fund or another fund, is going to be the answer. And so we always target a tax benefit of $80,000 per $100,000 invested. So you're able to reduce your taxable income. You can do the math. If you invest $100,000, if you invest $10 million, I mean, you can do the math. So if you've sold a business, sold a property, if you are a high wage earner, if you have some sort of liquidity event in something that you owned, if you have concentrated stock, a lot of that going on right now, tons of concentrated stock in the Mag 7. And I've seen just absolutely just crazy stories with individuals and the growth over the last 3 to 5 years, and the concentration has been so significant. And that's good luck. Not good luck. Congratulations, rather. It worked. Possibly look at realizing and diversifying into some other strategies. I see far too many people not wanting to diversify because of the taxes. That's a dangerous game, right? You either pay the taxes or you could potentially lose money, or it could keep going up like crazy. And, we don't think that ultimately is the case, especially with Iran. But the beautiful thing about the energy fund is a lot of the assets, all of the assets that we currently have in the fund were priced, and economics were run at a much, much, much lower oil price. So what does that mean? Well, in theory, you would think when we run economics at 60 and oil's 90, well, that's a much, much better investment. And the beauty of a fund is that you benefit from everything that was purchased last year. And so if you have any interest in diversification, cash flow, and tax strategies, tax reduction, give us a call, 630-492-1912, 630-492-1912. We'll talk about the hedge fund and why that is becoming, I think, a necessity after the break.
Retirement looks different for everyone. Will you be sitting on your porch taking in the view, or will your porch be disappearing in the rearview mirror? Whatever your retirement dream, making it a reality starts with a plan. Robert Kuhn at Kuhn Capital Partners can help you create a financially secure and tax-efficient plan that is tailored to you. After all, you deserve to live your dream. Call 630-492-1912 and start planning for tomorrow and every day after. 630-492-1912 and visit us online at KuhnCP.com. Retirement is the destination, and getting you there is what we do. Whatever comes your way, we've got you covered. We're dedicated to providing investment management and strategic wealth planning that are right for you. Simply put, we strive to be our clients' trusted advisor. We've been helping families, business owners, and entrepreneurs just like you get ready for retirement for over 28 years. To talk with Robert Kuhn and his team, give him a call at 850-495-3033 or find out more at KuhnCP.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent SEC-registered investment advisory firm, headquartered in Oak Brook, 1415 West 22nd Street, 1415 West 22nd Street, fifth floor, suite 530. We are in the same building as Fidelity. So if you want to just Google Fidelity in Oak Brook, we're in the same building. So we look at the mall. So if you have any questions, any interest in stress testing your current portfolio, talking about strategies that we talk about on the radio, give us a call, 630-492-1912, 630-492-1912. We'd love to talk about our thoughts on Iran. We'd love to talk about our thoughts on the market. We'd love to talk about our thoughts on how we hedge the portfolio. And those are basic things that we just, they're so commonplace to us that I don't even really talk about it on the radio a lot, like the bank notes, for example, or the enhanced income yield notes or structured notes, however you want to call them. I can't tell you how many people say, well, we did research on them and we really couldn't find anything on them, or we did research on them and it was negative. Well, that was probably because it was a small bank or it was a church or something like that. With the evolution of the internet, I think it's you're gonna seek out whatever you're trying to seek out. If you want to see positive, you're going to see positive. If you want to see negative, you're going to see negative, and that's the thing that we try to really why we do the radio show is because our job is simply education. And I'm convinced, just based upon everybody that we meet, and we meet with a tremendous amount of people on a weekly and annual basis, and I continue to see portfolios that either A, loaded up with lifetime income annuities, and people are so unhappy because of the growth. And I continue to tell people who are looking at the lifetime income annuities that you are only taking your own money out of that account until the account goes to zero. When the account goes to zero, that means you've depleted your assets. You're just taking your own money out. Then the insurance companies start to provide you that lifetime income. And so from their pocket, from their account, and you have to look at actuarially, you have to look at, well, how do they limit that from happening? Well, they limit the growth. Again, unfortunately, those lifetime income annuities can sell on hypothetical back-tested data. And many people on the radio are pitching these. They may not say annuity, but they're pitching it because as soon as you walk into the office, it's first thing they're going to talk about, or that's what they're going to say. You need to put 80% of your money, 90% of your money, 70% of your money in. And we love the fact that people on this radio station and other radio stations keep talking about that, because that's phenomenal for us, because many of those investors that invested with them and invested on hypothetical performance that we know will never happen. It was back-tested, computer-generated hypothetical performance. You're just setting your clients up for a disservice, and then ultimately they reach out to us. And so that's, and others, not just us, of course. But that's great. So continue doing it. Thank you. 630-492-1912, 630-492-1912. But when it comes to hedging, these are words that, we just don't talk about because it's just second nature to us. And, so when we look at our portfolio, we always kind of break it down, obviously financial planning based. Financial planning based is so critical. Running out RMDs. If you have a IRA that's 7 figures or close to 7 figures or multiples of 7 figures, the RMDs that you're going to have to take out, unless you plan appropriately, will show you, based on our financial planning software, are going to be significant. And most advisors are going to advise against Roth conversions because, quote unquote, it doesn't make sense. Well, why are we saying it doesn't make sense? Well, I make too much money. Okay, well, that's something we have to model. And I can't convert X amount for a million reasons, right? Well, the advisor hasn't done the thorough tax analysis on what at least in many instances, what it's going to look like we run everything from when you have to start taking RMDs out to age 95. Do you live to 95? Who knows, of course, but we're going to run it out to age 95. But when you have a strategy like the energy strategy, the strategy like Bison 2, the strategy that can greatly reduce the additional taxable income that you're going to get from that conversion, it could reduce, it could eliminate, as long as you have capital outside of that Roth or outside of that I get all these acronyms, IRA, to invest in, we can greatly reduce or eliminate that additional income from the conversion. And again, bring your tax attorney in, bring your CPA in, whoever does your tax advice. We're not tax professionals, but this is very basic information, and we can work right alongside of them if that's what you would like. But that is the advantage of advisors like us, which there are very few that have access to these strategies. Not only access, they are our strategies. So that to me is critical. And so when you look at hedging a portfolio, we want to, and what we use to hedge portfolios, I mean, there's a million ways to hedge, but most advisors aren't doing it. Most advisors are only hedging with time, meaning when the markets go down significantly, which I don't even think we potentially have started to see any meaningful drawdowns. I'm not worried about big shocks down like '08 or, kind of what we saw here over the last few weeks. Generally, those are bought and they come back up pretty quickly. What I'm concerned about is the 2000, 2001, 2002, where we have subsequent down years. And that, to me, is far more dangerous and far more lethal than these big spikes down. Because if we stay flat for longer or below trend growth for longer, people's plans could become in disarray. And that's something that we're very, very concerned about. And so when we talk with a new prospective client, we are going to talk a lot about, and probably much, much more about, the downside and what our strategies are there to do. So when you look at hedging, I think if you just take the basic word hedge, you're trying to buy some sort of protection, or you're trying to create some sort of protection against the markets in an adverse market event. So the market's going down. And the banknotes are a hedge, and we are pricing those. Last one priced at 14.25. Major bank, I think it was Bank of Canada. I'm not sure if that was the bank, but anyways, J.P. Morgan, Citi, Bank of America, Goldman, UBS, Morgan Stanley, etc. And they are very simplistic strategies once we have educated you, because they may be complex at first, but when you look at the fact that a bank is putting their credit, their backing on the line, creating the investment, it's not our investment, and is so again, like the last one, 14.25 is what I think it priced at, maybe plus or minus a little bit, but 14.25, and as long as the indexes that note tracks are not down 30%, so from the day the note prices, they lock in the index. 3 indexes, whichever indexes that we're using. Generally, we use the same, but whatever indexes that note is tracking, it locks those indexes in on the date the note trades. And then each month, so it's a monthly anniversary, call it. So each month, as long as those indexes from issue are not down 30% at check-in. So each month they're going to check in. As long as it's not down 30% from the date the note tracks, you get paid your monthly coupon. That's a pretty strong hedge. And I mean, it's, you basically got 30% downside to make annually in cash flow. 14.25% is what the last one was. Now, again, they're very high. That's very high. Well, it was this time last year that we did a JP Morgan one, I think was over 15, but it was I can't remember. We're going back a little bit, but so generally they're 11 to 15 is what we call it. But with the volatility, they're pricing very high right now. But that's a hedge. That is a hedge inside of a portfolio. And we meet with more and more investors that listen to us on the radio that are currently working with an advisor, and they tell us that we talked with our advisor and they did not have a good understanding, a good working knowledge of what it was. That's why we're reaching out to you. Well, fantastic. That is what the purpose of this radio show is. 630-492-1912. 630-492-1912. So that's one strategy that hedges. Number 2, Bison Alpha, our hedge fund. Again, it's our hedge fund, so it is proprietary. It is our hedge fund. It's an event-driven hedge fund that can go anywhere, can go 100% cash. It can stay fully invested. We're not trying to outguess the market. We're not trying to time the market. We're looking for inflection investing. We're looking for investments that, in theory, have much more limited downside than upside. And we would much rather, so when you buy something, right, you want to define the downside and you want the upside to be much, much greater. And we can use options. We can use strategies that have very little downside, but if they work as anticipated, the upside is very, very meaningful. And that strategy, again, just launched fourth quarter. So, I mean, performance has been in line with the market. It was beating the market a little bit, but with the pullback, it's in line with the market. But again, if you're looking at 6-month performance as a determining factor of investing, don't even bother investing because it's just not even long enough. You have to look at more of the strategy. But we created a video, a video that you can watch to see if it makes sense for you as a piece of the pie. So 630-492-1912, that's Bison Alpha. So we would consider that a hedge. And then you have Bison 2, the energy fund, significant tax benefits, independent distributions from the assets, which, again, are going to be significant if oil prices stay at this price. That is a hedge. So 3 of our 4 strategies we look at as having an inherent hedge to the overall markets. And so that, to me, is what good advisors do. That, to me, is an institutional portfolio. That, to me, is something that investors, as long as you have $1 million, you can invest investable assets, not including your home. You can invest in Bison 2. As long as you have 2.1, not including your primary residence, or $1 million with the firm, you can invest in Bison Alpha. That, to me, is why we acquire the number of clients that we do that keep coming to us. And so that's phenomenal. And we'll certainly dive into more of that after the break. So 630-492-1912, 630-492-1912.
Are you close to or already in retirement and maybe you're not sure if your retirement plan is working as you'd hoped? Getting a second set of eyes on that plan is always a good idea. Call Robert Kuhn and his team at Kuhn Capital Partners for your retirement review. They'll be glad to sit down with you and talk about where you want to be in retirement and how to get there. So call today to set up your visit, 850-495-3033, or find out more at KuhnCP.com. That's KUHNCP.com. Retirement is the destination, and getting you there is what we do. Whatever comes your way, we've got you covered. We're dedicated to providing investment management and strategic wealth planning that are right for you. Simply put, we strive to be our clients' trusted advisor. We've been helping families, business owners, and entrepreneurs just like you get ready for retirement for over 28 years. To talk with Robert Kuhn and his team, give him a call at 850-495-3033 or find out more at KuhnCP.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent investment advisory firm headquartered in Oak Brook, right across from the mall, 1415 West 22nd Street, 1415 West 22nd Street, Suite 530. Come on in. We would love to meet with you or give us a call, 630-492-1912, 630-492-1912. Lots going on in the market. Do not wait. So many people that we talked to last year in the fourth quarter now are calling us back. And thank you. I mean, we really obviously like that. But you really have to challenge yourself to not make, I don't want to say not make investment decisions, because you always have to question your investment thesis. But we have a lot of people that talked with us, loved the strategy. Markets kept going up. Markets, kept going up, never going to go down. And they just it was just put on the back burner until the markets do what the markets did now. And that's okay. Please keep reaching out, because that, to me, is obviously very important. Because I think we could be at the very beginning of a prolonged period of time where average returns in the market are not met. 630-492-1912, 630-492-1912. And when I say average returns are not met at current valuations, Generally speaking, the 10-year annualized growth number is very low. And that's just because of where the valuations are in the market now. Now, that's history. History doesn't have to repeat itself. There's always a time where it's never happened. Well, it just happens. And so we hear that constantly. But market stress is surging, and it's surging at a rather rapid pace. And I don't think individuals are really giving the market enough. They're not just paying enough attention to what could happen if and when we see a meaningful correction. I mean, think about this. We're just a handful of percentages off an all-time high. Okay, I mean, the markets, other than some headlines and, of course, what's going on in Iran, I mean, the markets really haven't gone down yet. What happens to your portfolio if we see the markets go down 20%? What happens if we see the markets go down 30%? What happens if we see the markets go down 40%? What happens if we see 3 down years? Maybe only 10%, maybe only 22%, maybe only 13% in the third year. But what happens to your portfolio? What is the role of your advisor in that type of a scenario? And those are the questions that I believe you have to ask your advisor. Those are the questions, those are the conversations that you have to ask. What are your contingency plans? What do I own inside of my portfolio that if the markets go down, they can either protect or even make money? What do I own inside my portfolio that if the markets go down, they can protect my portfolio from going down or even make money? That is a very fair question. And now you're not going to have to ask that if you are already working with us, because you're going to know throughout the financial planning process, throughout the process of creating your financial plan, we're probably going to talk more about strategies like the banknotes that can deliver positive returns in negative markets. Positive returns in negative markets, 14.25. We priced that just last week, 14.25 with 30% downside protection. Now, if the markets drop more than 30%, well, guess what? You don't get a coupon paid that month. That is what the downside is. Well, there's certainly more downside and there's more upside than just putting that in a statement. I'm giving you the highlights here on the radio. Again, we have to talk about the entire strategy when we meet, and we have videos for that. And so that's one thing that I mentioned in the first segment. I like to, the way that I learn is at my own pace, right? Don't give me the sales pitch. Sure, tell me what's good, but I also need to know the good, the bad, and the ugly. So let me learn at my pace. And that's why, especially with the energy fund, that's why we are making the videos that we're making, because the energy fund, when we talk with an investor, and inside of our energy fund, that is called Bison 2, everybody hears the tax benefit. So we target $80,000 tax benefit for every $100,000 invested. Could it be more? Of course. Could it be less? Of course, but we do try to target at least 80%. So 80,000. So that's active income, that's passive income, that's 1099, W-2, capital gains. It doesn't matter. Just ChatGPT or whatever your favorite AI agent is, and type in there, what are the tax benefits of owning oil and gas, and it will give you the tax benefits, right? Because we're not tax professionals. This is not tax advice. We will work directly alongside of your tax advisor and let the professionals tell you that and question us. But that's what everybody hears. Everybody hears those significant tax benefits, and they are so darn meaningful. Don't get me wrong. And they can be used in so many ways. Offset RMD conversions to a Roth, or not RMD conversions, offset taxable income from converting from an IRA to a Roth. That is such a secret bullet that we have. I know very few advisors that have access to any of those types of strategies, let alone a strategy that's investing in deals of the Conocos, Exxon, Chevrons of the world in the number one oil field in the Permian Basin. We will put our strategy up against anybody's, but you get big tax benefits. But what about the cash flow? So, right, the bank notes, right, will pay As long as the indexes aren't down 30% from issue, you're going to get a monthly check. You're making money every month as long as they're not down 30%. That's a great bucket of a portfolio, 10%, 15%, 20%, 30%, 40%, whatever that number is. But Bison 2, those distributions, those cash flow that comes from the production of those wells, again, this isn't wildcatting, this isn't speculation, this isn't in central southern Illinois. Not to say that those those funds or those wells aren't good, but when we're putting our name on the line, we're working only with operators that you're familiar with, or if you're not familiar with, you can see that they're a major in the best oil field, in my opinion, in the world, in the Permian Basin. But that cash flow is coming no matter what. So we got the bank notes that could deliver positive returns in negative markets. We've got the energy strategy. This year, for example, we forecasted our wells to run at about an 18% cash flow, and at $55 oil. At $55 oil, 18%. And the beautiful thing of a fund, and that's why we structured it this, if those investors today invest in it, you still benefit from every asset that we purchased since the inception of the fund. That is a great thing. Now, we have to monitor that. We still have to buy assets, of course, for, to compensate for new investors. But think about that. So we targeted and we ran the economics in the engineering software at about an 18% gross cash flow this year. That was at $55 oil. Think if oil stays in the 80s, 90s, 100s, 110s, or whatever it does. I don't love these spikes. Yes, we get more cash flow, but again, it just is kind of chaotic. But think about that. So that cash flow could be significantly greater at much higher oil prices. So we have two buckets of our four, or sleeves or philosophies of our four, that I just shared with you that can make money even when the markets are going down. Now, the bank notes, again, 30% downside protection. What do you have? What do you have inside of your portfolio that can compensate from the equity losses? Because our equities are going to go down on our traditional equity strategy just like everybody else's. Now, historically, they have greatly outperformed the S&P. It's third party. If you go back to 1995, it's massively outperformed the S&P. But again, that's past performance. And we always have to qualify anything in the past as it's not indicative of future results. Now, I think it is a little bit more indicative of what could happen because it's quantitative in nature. It's a massive manager that has a very mathematical process. But I want to know for you, for what is the advisor bringing to the table? That's what I want to know. What is the advisor bringing to the table? And if you can't, I would venture to guess almost every one of our clients that has all four of our strategies, or three of the four, that they could articulate to you at a high level how each of those strategies could deliver positive returns in, not the equities, but so I'll say three of the four. So we'll do the bank notes, we'll do the hedge fund, and we will do Bison 2, how they could make money even though the markets are going down. And the hedge fund, man, we love it. Absolutely love it. That is more, obviously tied to the equity markets, of course, because it doesn't have a defined downside. But so let me take that statement back. Two of our strategies. So the bank notes and the energy fund, they can articulate how those are going to make money even if the markets are down. So that's 50% of a portfolio that has the ability to generate positive returns even in negative markets. What do you have? What is your advisor bringing to the table, especially if you're that $1 to $15 million investor? That's kind of where we live, in the $1 to $20 million kind of net investable asset range. And again, we work with $500,000 investors. We work with $750,000 investors, but our sweet spot kind of is that $3 to $15 million range. But what are they bringing to the table? And that's what you have to ask yourself, especially in this market. So 630-492-1912, 630-492-1912. More after the break.
Retirement is the destination, and getting you there is what we do. Whatever comes your way, we've got you covered. We're dedicated to providing investment management and strategic wealth planning that are right for you. Simply put, we strive to be our clients' trusted advisor. We've been helping families, business owners, and entrepreneurs just like you get ready for retirement for over 28 years. To talk with Robert Kuhn and his team, give him a call at 850-495-3033 or find out more at kuhncp.com. Retirement looks different for everyone. Will you be sitting on your porch taking in the view, or will your porch be disappearing in the rearview mirror? Whatever your retirement dream, making it a reality starts with a plan. Robert Kuhn at Kuhn Capital Partners can help you create a financially secure and tax-efficient plan that is tailored to you. After all, you deserve to live your dream. Call 630-492-1912 and start planning for tomorrow and every day after. 630-492-1912 and visit us online at kuhncp.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent SEC-registered investment advisory firm, headquartered in Oak Brook. So stop in and see us. Only downside to stopping in without an appointment is you get to enjoy coffee from our fancy coffee machine. So that's certainly not a downside. You get to look at and go down memory lane of all of our signed, autographed sports jerseys in the office. That's not a downside. The only downside is we're probably in a meeting, either in person or on a conference call or a Zoom. So you may have to wait a few minutes, but that's okay. So if you're willing to do that, stop in. 630-492-1912 is our number. So if you don't want to potentially wait, give us a call, 630-492-1912. Set some time to talk. Our conversations are generally, I'd say, probably 50% in office and 50% the initial conversation, 50% over Zoom or conference call or something like that. So we're utilizing technology. We love it, absolutely love it. So if you're not 100% convinced that you have strategies in place that can weather a prolonged down market, sideways, flat market, then we need to have a conversation. 630-492-1912, and we would love to do that. So, the market risk happens fast. We talk an awful lot about, and it's just kind of our passion, too much so, to be honest, many times. I can't tell you, especially with everything that's going on. It's not uncommon to get text at hours that you would not expect to get text and tweets and, stuff from our team, trying to strategize, trying to challenge our thesis, trying to question, what it is that we're looking at, what we're doing, what we own. But that, again, is our job. That is our job. Advisors generally just want to sit back, show you a graph, a chart of 100 years in the market, and everything looks rosy. And newsflash, markets always go up. Markets always go up. Markets always go up. But the qualifier is over time, right? And so what is that time period? What is that time period? And those are the things that we really, that's why we do what we do. My belief is that more advisors are, generally, they're not investing the way they recommend. The bulk of advisors are going to recommend set it, forget it, diversify, whatever diversify means, because diversification to the traditional advisor is stocks and bonds. I mean, is that diversified because you own equities and you own fixed income? I mean, is that diversification? I mean, maybe in the 80s. I don't think it's diversification in the early 2000s. I certainly don't think it's diversification in the mid, 2026. But that, unfortunately, is what advisors are doing, because many times advisors, especially if they're with the big banks, the big brokerage firms, their hands are tied. Their hands are tied on the strategies that they have access to. Their hands are tied at the strategies they have access to based upon what their firm says they can invest in for their clients. Generally, it comes down to some sort of pay-to-play where there is some sort of a revenue-sharing agreement in place that, and that's just the way it is, unfortunately, even for smaller advisors. That a lot of times is, what are you going to give me by allowing our advisors to offer your strategy? And that's one of the reasons I love being independent registered investment advisor. That's one of the reasons I love having two private strategies that are ours, the hedge fund in Bison Alpha and the energy fund in Bison 2. That is, to me, our secret sauce. And then you add on top of that the bank notes that, again, 14+% is the last one we priced with 30% downside. The amount of money that we did in the bank notes last year in a strategy that I thought was so second, I didn't even think that the bank notes, if you've listened to the radio show for any length of time, we didn't start talking about the bank notes, I don't think, until on the radio, until maybe beginning of 2025. And then I saw just the inflow of interest in strategies that, provide a downside and can deliver, double-digit, cash flow on an annual basis, as long as, those 30% downside or 40% downside or whatever that downside is not breached. That I just realized that, my goodness, advisors are not doing their job, in my opinion, of educating investors of what is out there when the markets go down. I listen to the radio just like you guys are listening to the radio, and it's annuity pitch after annuity pitch after annuity pitch wrapped up as financial planning. And as I've always told people, there are certain instances where lifetime income can make sense. It's just not at scale, right? And so is my belief. So when you go with an advisor, you have to ask what percentage of your clients, what percentage of your firm's revenue is derived from X. You can ask that question, and they have the right not to tell you, but they should tell you. And then you can check and you can really determine the independence of their strategies. And I don't think independence is the right word, but you get what I'm trying to say. Objectivity, okay. And that's a challenge. And so everybody says, well, you don't like annuities. No, couldn't be further from the truth. We have a 5-year annuity that is outside of our advisory practice, of course, but it's 5-year annuity that we use for clients that are very, very concerned or that want to offset or use it as a bond replacement. It's a 5-year annuity, no income, and it's simply tied to the S&P 500. Now, there are other investment options. We generally choose the S&P, but it's very simple. The year you buy it, they look at it 1 year from that day. And as long as if the index is negative, your return's zero. Now, again, it's not backed by the government. It's backed by the insurance companies, of course, but your return is zero. Zero. So if the market's down 1 or the market's down 50, your return is zero. Now, the trade-off to that is there's a cap on the upside. Currently, the cap is 10.5%. Now, that cap can change, of course. Currently, though, it's 10.5%. Now, the downside to this is you don't get the dividends, but that's the price movement is still significant of the S&P. So you can't say that we don't like annuities because that strategy is an annuity. It's just a shorter term annuity that is very understandable to the client, doesn't produce income, because if we're looking for cash flow, I want to take the current annuity you own and compare it to the bank notes. And then let's look at the cash flow, because most people are being told to defer cash flow from these annuities, 5 years, 10 years, whatever. And they're being shown ridiculous growth rates of hypothetical back-tested data, and which never happens. And the income is so strong that I would invest in it. But I know what to look at. I know how I can look at that index, and I can look at the real returns, not just the back-tested returns. So I love the 5-year annuity. And it's simple, it's basic, and it can be, again, a great hedge to the equity markets. And now, the reason why, in my opinion, bigger firms like ours and firms larger than ours don't utilize them to the extent that they do is because they pay a commission. Because those annuities pay us 5%, 6%, 7%, whatever the commission is. Now, you don't pay it, quote unquote. It doesn't come out of your account. The insurance companies pay it. Now, there are surrender charges that you have to deal with if you were to get out of it before 5 years. So I think we always pay it somehow. But most firms are not going to talk about that because we don't want the commission. We don't need that big influx of capital to pay more taxes. We would rather have a fee because it is much more predictable, down the road. But how I'm compensated should have zero bearing on what we are recommending. But in the industry, it does. So hopefully this show, you got more education than you started with. That's the job of every show that we did. If we can help you, if you want to challenge us, if you want to challenge your advisor, if you want to challenge your thesis, we can help you do that. 630-492-1912, 630-492-1912. Banknotes are still pricing very, very strong, as strong as we've seen in a long, long time with this volatility, 14%. With 30% downside. Those are monthly coupons. Again, if you want to take a look at the prospectus of one that we did previously before you do it, if you want to watch a video, just give us a call, 630-492-1912. If you want to hedge or have a strategy that can hedge, that can go short, that can go to all cash, that can be a good complement to a traditional equity strategy, Bison Alpha, our hedge fund, is something to consider. Again, great video that we have on that. Just give us a call and we can certainly send out that video so you can listen to it at your own leisure and see if it makes sense. 630-492-1912. And then lastly, the energy strategy, tax reduction. Again, tax reduction. We're not tax professionals. This is very black and white tax benefits in oil and gas investing. But tax reduction is significant. And then at these oil prices, we run everything in the 60s, and we had strong distributions. Well, with these oil prices, obviously they're only going to be greater if these oil prices stay. The best thing about the fund is it's a fund, and so you benefit from every asset that we purchased over the last 18 months, and it's kind of a free look of what's going on and what we own. So we'd love to walk all of that through you. Again, videos we have there too. So hopefully everybody has a great week. Stay informed, think about challenging your thesis in this market. And if we can help you do that, stop in or give us a call, 630-492-1912, 630-492-1912. More next week.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guest unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.